Silver Jolt, futures. Whiplash, physical supply strain, and a possible U.S. stockpile. Something happened overnight. While most traders were asleep, silver didn't just fall, it was pushed hard, double-digit drops in the thinnest trading hours when liquidity vanishes and stop losses detonate like tripwires. But here's what doesn't make sense. Futures collapsed, yet physical metal? Still tight, still expensive, still scarce. Dealers can't keep inventory. Refineries are backlogged. Industrial buyers are scrambling. And then, whispers from Washington. A strategic stockpile, possibly being considered, for a metal the United States barely produces. Three forces, converging at once. Paper markets breaking, physical supply straining, and policy moving in the shadows. What happens when all three collide? Welcome to Metal and Macro, where we don't just report the news, we decode what it actually means for your capital, your business, and your strategy. Now, if you've been watching markets long enough to remember when information wasn't free, when analysis required effort, when patience was a virtue, then you understand the value of what we do here. So do us a small favor, would you? Hit that subscribe button, not because we're asking for applause, but because serious economic analysis deserves serious audiences. And while you're at it, drop a comment below. Tell us, what city, what country, what corner of the world are you watching from today? Because this story, it's playing out globally, and we want to know where you're standing when the pieces start falling into place. Now, let's break this down. February 7th, 2026. The sun had not yet risen over New York, but somewhere in the world, someone was watching silver fall apart. It happened during the hours when most American traders were asleep, when liquidity thins, when order books grow shallow, when a single large trade can move the entire market like a hand pushing through water. Silver dropped hard. Not a gentle decline, not a measured retreat, a violent double-digit percentage plunge. The kind of move that makes risk managers wake up in cold sweats. By the time dawn broke over Manhattan, silver was sitting in the high 20s per ounce. Gold, by contrast, had barely flinched. It was down only a couple of percentage points, hovering just below $5,000. That divergence told a story. When silver falls and gold doesn't, when the gap between them widens suddenly and sharply, it means something specific is happening to silver. Something isolated, something structural. The gold to silver ratio, a number traders have tracked for centuries, spiked back into the 60s zone. That ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When it rises, it means silver is getting cheaper relative to gold. When it rises fast, it means someone is either selling silver aggressively or buying gold defensively, or both. But here's what made this move different. It didn't happen during regular trading hours. It didn't happen when New York was awake, when Chicago was active, when the full weight of American capital was watching screens and placing orders. It happened overnight. And overnight markets are different animals entirely. During regular hours, futures markets are deep. There are buyers and sellers stacked at every price level. Large orders get absorbed. Volatility stays contained. The system has shock absorbers. But overnight, those shock absorbers disappear. Fewer traders, fewer orders, fewer market makers standing ready to catch falling prices. A large sell order that might barely register during the day can punch straight through the order book at night, triggering stop-loss orders, setting off automated risk systems, forcing other traders to sell even if they didn't want to. It's called a cascade. One sale triggers another. That sale triggers 10 more. Those 10 trigger 100. The selling feeds on itself like a fire finding oxygen. And the question everyone was asking by morning was simple. Did this cascade happen naturally, or was it engineered? Because when you short a futures contract, you're making a bet that the price will fall. You borrow the contract, sell it at today's price, and hope to buy it back cheaper later. If you're right, you profit. If you're wrong, you lose. But if you're large enough, if you have enough capital, if you understand market structure well enough, you can do more than just bet on a price drop. You can cause one. You can sell aggressively during thin hours. You can target the exact price levels where stop losses cluster. You can push the market just hard enough to trigger a wave of forced selling, and then profit as the cascade does the rest of the work for you. That's not a conspiracy theory. That's market mechanics. It happens in stocks, it happens in currencies, it happens in commodities. And silver, with its relatively smaller market size compared to gold, is especially vulnerable to this kind of pressure. But here's where the story gets interesting. By midday, reports started circulating. Unconfirmed at first, then more insistent, then impossible to ignore. Certain exchanges had stepped in. They had restricted accounts from opening new short positions in silver. Read that again. Exchanges, institutions that make money from trading volume, that love volatility, that thrive on activity, had intervened to limit trading. That almost never happens. Exchanges don't restrict trading because they're worried about traders losing money. They restrict trading when they're worried about systemic risk, when they see something in the order flow that scares them, when the structure of the market itself looks fragile. So the question wasn't just, why did silver fall? The question was, what did the exchange see that made them pull the emergency brake? Because if the futures market was showing cracks, if the paper contracts that dominate price discovery were becoming unstable, then traders needed to look somewhere else for answers. They needed to look at the physical metal itself. And that's where the story stops making sense. While the futures market was collapsing, something strange was happening in the real world. Silver wasn't getting cheaper, it was getting harder to find. This is the part that breaks most people's understanding of how markets are supposed to work. Because according to everything they teach in economics classes, when price falls, supply should increase. Sellers should flood the market. Inventory should pile up. But that's not what was happening. Coin dealers were reporting the opposite. Physical premiums, the amount buyers pay above the spot price to actually hold metal in their hands, were not shrinking. In many cases, they were rising. Delivery times were stretching. Some products were simply listed as out of stock or call for availability, which means this. The screen said silver was cheap, but the real world said silver was scarce. Two realities, same metal, completely different stories. And if someone wanted to understand what was really happening, they had to stop watching the screen and start watching the metal itself. Because physical silver and paper silver are not the same thing. Paper silver is a contract, a promise, a bet on future price movement. Traders buy and sell these contracts thousands of times per day without ever touching actual metal. Most futures contracts expire without delivery. They're cash settled. They're tools for speculation and hedging, not for holding. Physical silver is different. It's mined from the earth, refined into bars and coins, shipped to vaults and dealers, bought by people who want to hold it, store it, use it. And here's the critical detail most people miss. Roughly 70 to 80% of silver production doesn't come from silver mines. It comes as a byproduct. When companies mine for copper, they get silver. When they dig for lead or zinc, they get silver. Silver shows up as a side benefit, not the main objective, which means silver supply doesn't respond quickly to silver prices. If silver doubles in price tomorrow, mining companies don't suddenly produce more silver. They produce more copper or more zinc, and silver just happens to come along for the ride. So when demand for physical silver rises, supply can't just increase to match it. It's structurally constrained. And demand? Demand was not falling. Industrial buyers, the companies that actually use silver to make things, were still buying. They had no choice. Because silver isn't optional in their production processes. It's in solar panels, essential for the photovoltaic cells that convert sunlight into electricity. It's in electronics, circuit boards, switches, conductors. Silver's unique properties make it irreplaceable in high-performance applications. It's in medical devices, antibacterial coatings, wound dressings, diagnostic equipment. When a solar panel manufacturer needs silver, they don't check the futures price and decide whether to buy. They buy. Because without silver, they can't manufacture. Without manufacturing, they have no revenue. Without revenue, they have no business. This is what economists call inelastic demand. Price goes up, they still buy. Price goes down, they still buy the same amount. They're not trading, they're consuming. And consumed silver doesn't come back into the market, it's gone, embedded in products, spread across millions of devices, functionally unrecoverable in most cases. So while traders were panicking over futures prices, industrial buyers were quietly continuing to pull metal out of the supply chain at the same steady pace they always had. But there was another buyer entering the equation: investors. Not the futures traders flipping contracts for profit, not the speculators playing volatility, the people who wanted physical metal, the ones who saw falling futures prices and thought, this is my chance to buy real silver at a discount. And they were calling dealers, placing orders, wiring money, only to discover the same problem everyone else was discovering. Metal was tight. Dealers were quoting longer lead times. Premiums were sticky. Some products were simply unavailable. The retail market, the layer where individual buyers interact with physical silver, was showing signs of stress. One dealer might have inventory, another might be sold out, a third might be rationing purchases or requiring deposits weeks in advance. None of this showed up on the futures screen. The screen showed a number, a price, a clean, simple data point. But behind that number, the physical market was telling a completely different story. And then there was the geopolitical layer. Because silver doesn't come from everywhere. Mexico is the largest producer. Peru is second, China is third, Australia, Chile, Russia. These are the countries that matter. And every single one of them is watching what the United States does, watching tariffs, watching trade relationships, watching currency moves. Some are considering export restrictions. Some are talking about resource nationalism. Some are quietly building their own strategic reserves. When supply is concentrated in a handful of countries, and when those countries start thinking strategically instead of commercially, markets stop behaving like markets. They start behaving like chessboards. In the United States, the country that consumes massive amounts of silver for defense, technology, and infrastructure, it produces almost none of it domestically, which raises an uncomfortable question. If physical silver is already tight, if industrial demand is relentless, if supply is geographically concentrated, what happens if the US government decides it needs a stockpile? There's a moment in every strategic crisis when governments stop talking like economists and start talking like generals. That moment usually arrives quietly, no press conferences, no dramatic announcements, just a shift in language, a change in priorities, a reallocation of budget lines that most people never notice. And if someone was watching closely enough, they might have started noticing that shift happening around silver. Because governments don't stockpile commodities for profit, they stockpile them for survival. The United States has done this before, many times. The Strategic Petroleum Reserve wasn't created because oil was a good investment. It was created because oil is a weapon, because supply can be cut, because dependence is vulnerability. The same logic applied to rare earth elements when China threatened export restrictions, to semiconductors when supply chains fractured during the pandemic, to baby formula when shortages hit American shelves. Every time the pattern was the same. First came dependence, then came disruption, then came panic, then came policy, and silver. Silver was checking every single box on that list. The United States military doesn't function without silver. Missile guidance systems, radar components, night vision equipment, communications, infrastructure, satellites, all of them depend on silver's unique electrical and thermal conductivity. There is no perfect substitute. There are workarounds, yes, compromises. But in defense applications, compromises can mean the difference between systems that work and systems that fail when they're needed most. And it's not just defense. The renewable energy transition, the one every Western government has committed to, is impossible without silver. Solar panels require it. Grid infrastructure requires it. Battery technology improvements are exploring it. If the goal is energy independence, if the goal is reducing reliance on foreign oil and gas, then silver isn't optional, it's foundational. But here's the problem. The United States doesn't mine enough silver to meet its own needs, not even close. According to the most recent data, domestic production covers maybe 10 to 15% of domestic consumption. The rest, imported, from Mexico, from Peru, from Canada, from countries whose political stability and trade relationships cannot be taken for granted. So when analysts started hearing whispers about a possible U.S. silver stockpile, it wasn't surprising, it was overdue. The whispers didn't come from official statements. They came from budget requests, buried in appropriations documents, from procurement patterns that didn't quite make sense, from quiet conversations with defense contractors who were being asked unusual questions about metal availability, nothing confirmed, nothing definite, but enough breadcrumbs to make people start asking, what if? What if the U.S. government decided that silver was a strategic vulnerability that needed to be addressed? What if they decided to build a reserve, the same way they built the petroleum reserve? What if they started buying? Because if that happened, the market would change overnight, not because government buying would be large in absolute terms. The federal government couldn't outbid the entire industrial sector, even if it wanted to, but because it would send a signal that silver wasn't just a commodity anymore, that it was strategic, that it mattered to national security, that other governments should probably be thinking the same way. And when governments compete for the same resource, prices don't move in straight lines. They jump. Look at what happened with rare earth elements. For years, they traded quietly. Then China restricted exports. Then governments panicked. Then prices exploded. Then every Western nation started scrambling to secure alternative supplies, often paying multiples of what the market price had been just months earlier. The pattern is always the same. Complacency, disruption, recognition, reaction, and by the time the reaction comes, the easy buying opportunity is gone. Now, some analysts were dismissing the stockpile rumors entirely. They pointed out that there had been no official announcement, no line item in the budget labeled Strategic Silver Reserve, no congressional hearings, no public debate, and they were right. But they were also missing the point, because strategic stockpiling isn't always announced in advance. Sometimes it happens quietly, through proxies, through long-term procurement contracts with domestic producers, through agreements with allied nations to secure supply corridors, through financial incentives for companies to expand refining capacity on U.S. soil. The goal isn't to make headlines. The goal is to secure supply before the market realizes what's happening. And there was precedent for this. During the Cold War, the U.S. maintained strategic stockpiles of dozens of materials. chromium, manganese, cobalt, titanium. Most people never knew they existed, but they were there, sitting in warehouses, waiting for a crisis that might never come. Some of those stockpiles were eventually sold off when the threats diminished. Some were never used at all. But the logic behind them was sound. In a world where supply chains can be severed, where trade relationships can collapse, where adversaries can weaponize resources, dependence is a national security risk. And right now, the United States was dependent on foreign silver. So the question wasn't whether a stockpile made strategic sense. The question was, had someone in Washington already reached that conclusion? And if they had, were they already buying? Because if the answer was yes, then the futures market collapse, the physical tightness, and the policy signals weren't three separate stories. They were three chapters of the same story. A story about a market that was being reshaped, not by traders, but by forces much larger and much less visible. And the people who understood that, the ones who saw the structure shifting beneath the surface, they weren't asking whether silver would recover. They were asking how fast and how far. Three threads, three separate realities, all pulling in the same direction. The futures market showed chaos, violent overnight moves, exchange interventions, cascade selling that looked orchestrated, or at least opportunistic. The physical market showed scarcity, premiums that wouldn't fall, dealers running tight on inventory, industrial buyers consuming metal at rates that wouldn't slow down regardless of price. And the policy layer showed awareness, quiet signals, strategic thinking, the kind of government attention that doesn't appear in press releases, but shows up in procurement patterns and budget footnotes. When these three forces converge, markets don't behave normally. They reprice. Not gradually, not predictably, suddenly. And the people who understand this, the ones who've watched it happen in oil, in rare earths, and semiconductors, and fertilizer, they know what comes next isn't a forecast, it's a pattern. But here's what makes this moment different from typical commodity cycles. Most commodity squeezes are temporary. Supply responds, new mines open, substitutes emerge. Demand softens. The market rebalances. Silver doesn't work that way. Supply can't surge because most silver is a mining byproduct. Production is tied to copper and zinc and lead, not to silver prices. Even if silver tripled tomorrow, new supply wouldn't flood the market for years. Mines take time, permits take time, infrastructure takes time. And on the demand side, there's no easy substitute for most of silver's industrial uses. Engineers have spent decades trying to replace silver in electronics and solar panels with cheaper alternatives. Some progress has been made, but in high-performance applications, silver remains unmatched, which means this. If supply is structurally constrained, and demand is structurally inelastic, and government policy is starting to treat silver as strategic, then the current price might not reflect reality. It might reflect a futures market that trades paper contracts while ignoring what's happening to the actual metal. So what does this mean for someone allocating capital? First, it means understanding the difference between exposure types. Futures contracts or leverage. They're tools for traders who want price movement without holding physical metal. They're efficient, they're liquid, but they're also fragile. A margin call doesn't care about long-term fundamentals. A forced liquidation doesn't wait for the thesis to play out. Physical metal is different. It's an asset. It sits in a vault or a safe. It doesn't generate cash flow, but it also doesn't generate margin calls. It's patient capital, the kind that survives volatility and waits for repricing. Mining equities are another option. They're leveraged bets on silver prices without the margin risk of futures. When silver moves, mining stocks typically move more, but they come with company-specific risks, management quality, jurisdictional issues, operational challenges. ETFs offer a middle ground. Physical-backed ETFs hold actual metal in vaults. They're more accessible than buying bars and coins directly, but they come with counterparty risk, storage risk, regulatory risk. Each approach has trade-offs. The right choice depends on time horizon, risk tolerance, and conviction level. But the deeper question isn't about instruments, it's about framework. Because most investors approach commodities as trades. They watch charts, they follow momentum. They try to time entries and exits based on technical levels or sentiment shifts. That's not wrong, it's just incomplete. Strategic allocators think differently. They ask, what's the supply situation? What's the demand trajectory? What are governments doing? What happens if I'm right? What happens if I'm wrong? And right now, the answers to those questions all point in the same direction. Supply is tight and structurally limited. Demand is relentless and growing. Governments are paying attention in ways they weren't 5 years ago. That doesn't mean silver goes up tomorrow. It doesn't mean there won't be more volatility. It doesn't mean the futures market won't stage another dramatic sell-off. It means the setup is asymmetric. The downside is visible. Futures could fall further. Premiums could compress if investor demand weakens. A global recession could slow industrial consumption temporarily. But the upside? The upside is structural. If physical shortages intensify, if a government stockpile gets announced, if solar deployment accelerates faster than supply can respond, if geopolitical tensions disrupt trade flows, then repricing doesn't happen in increments, it happens in leaps. And by the time it's obvious to everyone, the opportunity is gone. That's the nature of supply-constrained markets with inelastic demand. They sit quietly for long periods. Then they move violently when the narrative shifts. The professionals watching this space aren't asking whether silver will rise. They're asking, what size position makes sense given the risk-reward profile? What's the right entry strategy in a volatile market? How much exposure is prudent without over-concentrating? Because the goal isn't to bet the entire portfolio on a single commodity thesis. The goal is to position intelligently for scenarios that the market isn't pricing in yet. Scenarios like a government announcement, like a supply disruption, like a solar boom that exceeds expectations, like a derivatives crisis in the futures market that forces a repricing of physical metal. None of these are guaranteed, but all of them are plausible. And in markets, plausibility matters more than certainty, because certainty is expensive. By the time everyone agrees on what's happening, prices have already moved. Plausibility is cheap. It's the recognition that conditions are shifting, that structures are under stress, that the gap between paper and physical is too wide to ignore. And right now, that gap is widening. Futures markets are flashing red. Physical markets are holding firm. Policy signals are emerging. And what happens next isn't predictable, but it is consequential. And the people who understand that, the ones who've watched this pattern play out in other markets, the ones who know the difference between trading volatility and positioning for structural change, they're not waiting for confirmation. They're already moving. Not recklessly, not emotionally, strategically. Because when three forces converge, market structure stress, physical supply constraint, and government policy attention, the question isn't whether something will happen. The question is, will you be positioned when it does? The story is still unfolding. Futures markets will keep moving. Physical premiums will keep shifting. Policy signals will keep emerging. And the allocators who treat this as noise, who wait for clarity, who need certainty before they act, they'll watch from the sidelines, while the ones who understand structure, who recognize asymmetry, who know that markets reprice faster than most people can react, they'll already be there. This is Metal and Macro, where we don't just watch markets move, we decode why they're moving and what that means for capital. If this breakdown added value, subscribe, share it, comment below with where you're watching from. Because the next chapter of this story, it's already being written.